Deciding what to trade. So in this video, we are going to go over different types of trading instruments and picking what you want to trade. So as you guys progress as traders and you're ready to trade, there are two types of trading instruments. There are stocks, which we have covered, and then there's obviously options, right? Now, when you guys get into stock trading, there's two different type of stocks. There's obviously the large caps and there's obviously the small caps. Now, when you guys are trading options, the options are coming, the option contracts are coming from these companies, right? So obviously everything starts from point A, and then from point A, you go to point B, which is options. Now, some people do not like trading options. They're not fans of trading options. That's totally okay. But some people love to trade options. They don't really like to trade stocks at all. That all depends on you, on what you want to trade, what you want to go, what financial instrument you want to go about, right? Now, when you're starting out, let's say you want to start with stocks, you have to understand, once again, there's two different type of stocks. You need to pick what trading instrument you're going to trade, why you're going to trade that trading instrument, and you need to have a solid understanding. So when you're picking your strategy, you can't just say, okay, I'm going to trade tomorrow. No, what are you going to trade? If you're going to trade stock Roku tomorrow, are you looking to trade the options? Are you looking to trade the stock? If you're looking to trade the options, what are you looking to buy? Calls, puts, what's your expiration date? What's your strike? All these things need to be factored in when you're trading options. Now, what is the primary difference in trading stocks or trading options? Now, stocks are the best for beginners. So if you're someone that just started trading or you're looking to start trading, start off with trading a stock. Buy and sell a stock. Do not jump into option trading because it is very, very risky. Stocks are easy and straightforward. Okay. Once you own a stock or trade it, you don't have to worry about other complicated factors. For example, if I go and I buy a stock right now for $10, right, and I hold it, let's say overnight, and tomorrow the stock goes to 11, I immediately make a profit of $1. There's nothing else I have to worry about. Now, if I buy a stock at $10 today and tomorrow that stock goes to 8, I lose $2. There's nothing else I have to worry about. If I buy a stock today at 10 and I want to hold for a week, 2 weeks, 3 weeks, there's nothing else I have to really worry about. So when you're trading stocks, they're straightforward, very easy. Now, stocks obviously have less leverage compared to options. Now, this is not a bad thing. A lot of people look at this and say, well, I want to trade options because options have a lot of leverage, right? You can obviously make a lot more money trading options, but there's a lot more complicated factors and obviously risk involved when you are trading options. Now, let's go to the option side. Now, options are best for active, experienced traders. So once you get to a level where you're comfortable, you get more experience, I think that's a time for you to maybe jump into option trading. I don't think right off the bat you jumping into option trading would be the best idea. I think trading stocks would kind of allow you to get more comfortable, understand price action a little bit better, and obviously there's not a lot of complicated factors involved when you're trading stocks. Now, when it comes to options, once again, in my personal opinion, is you should start trading options once you become a little bit more experienced. Now, options are also more complex. There's a lot of different factors. So once you own an option contract or trade it, you have to factor in other complicated factors, right? There's a time decay. Basically, when is your option contract expiring? What is your strike price? What's the delta? Like, there's so many things involved when you're trading options, right, that kind of throw off somebody that's just starting out. So if you're just starting out, looking at all these things are going to make you very, very confused. Now, the great thing about options, obviously, is that it gives you more leverage compared to stocks. Stocks don't give you that much leverage as much as options do, meaning you can make a lot more with options, but you need to be careful, guys. Do not jump the gun. Do not jump right into options. Take it one step at a time. Now, another thing with options and stocks is on stocks, if you want to buy the stock at 10, you just hit buy and you buy it at 10. With options, if the stock is trading at 10, and let's say you want to buy the options for this stock that's trading at 10, you have to once again look at the strike price, right? The contract you're buying, what contract strike price are you buying, right? What's the expiration date? Like there's a lot of things you need to look into to select the proper option contract that you're actually going to trade. Why are you going to trade that? So for someone starting out, the thinking process becomes a lot larger and longer opposed to someone just trading stocks. So once again, my personal opinion would be if you're starting out, trade stocks. Once you kind of get good at this, once you kind of get a hang of trading stocks, you can slowly shift this way over to option trading. Now, when you guys are trading stocks, the second thing you have to understand is that there's two types of stocks, right? And I think a lot of people tend to not understand this. There are two types of stocks. So we have large caps and we have small caps. So large caps are safer companies, meaning there's less risk, but also less profit. In large caps, you can invest and hold overnight. Like if I was to buy a large cap company like Apple, Microsoft, Amazon, I would kind of be a little bit more comfortable holding it overnight opposed to maybe a small cap. Large caps are also easier to trade options on these because of high liquidity. So when you guys do want to shift over to trading options, you're going to have to look into large cap stocks, Microsoft, Apple, Amazon, Netflix, Facebook, so on. Small cap stocks are not going to have a lot of liquidity, especially with options. Now, small caps, there's a lot of risk associated with small caps, but also more profit potential. Small caps need to be very careful holding these overnight. Now, another thing with small caps, as I mentioned, it's harder to trade options on these because of low liquidity. So once again, when you want to transition over to options, or if you are trading options, you want to primarily look at large caps because liquidity is a very, very big problem when it comes to option trading, guys. So keep that in mind. Now, the reason I bring this up on the large cap and small cap stocks is because a lot of people don't understand the basic concept that goes behind this, right? Now, for example, let's say I take a stock called Apple. Everyone is familiar with Apple. Let's say we look at Apple. Now, Apple is trading at, let's say, $220 right now, okay? Now, let's say next I take a small cap company. The small cap company I take is also trading at $220. Now, there's a few things I want you guys to understand before I move forward. When I say large caps are safer, that does not mean each and every single large caps are safe. That means majority of them are better companies and more safer investments than maybe small caps. Not saying small caps are bad, but you have to be more careful when you jump into these type of trades or these type of stocks, right? But going back to what I was saying, now Apple might be worth $1 billion. I mean 1 trillion, not 1 billion, I'm sorry. Apple is worth $1 trillion, meaning their market cap is 1 trillion. They're a very large company, right? Now, a small cap company might be worth, let's say, I don't know, 500 million. Let's say 500 million. Now, what a lot of people tend to confuse, and I went over this in the introduction videos, people think that if I trade Apple, right, and let's say company ABC, let's say tomorrow company ABC goes from $220 to $300, it makes an $80 move in a day, right? And one day it goes up $80. Now, if someone sees that, they're like, wow, company ABC went up $80. Wow, that means Apple is going to do the same thing. Apple is going to have a very hard time going up $80 a day. Why? Because Apple's market cap is obviously larger than company ABC. So when company ABC goes from $220 to, let's say, $440, meaning it goes up 100%, that means the market cap only increased by 500 million, which sounds like a lot, but it's not a lot in the market. Now, if Apple goes up from 220 to 440 and adds 100% to their market cap or doubles, their market cap goes from $1 trillion to $2 trillion. If you look at that, that's a major, major difference. Now, if we break it down, let's say Apple goes up only 10%. Now, you can compare these two companies and say, well, Apple went up 10%, it's at 220. This company went up 100% and they're also at 220. Why is Apple not jumping more? Because Apple going up 10% is still $100 billion, which is far more than the market cap of this company, right? For this company to go up 100 billion, they're gonna have to go up so high, right? So that's a very important thing for you to understand, because when I'm trading large caps, I understand that they're not gonna make 30, 40% moves up in a day. I know small caps are, but I also know small caps are gonna make massive moves down. Large caps are probably not, right? So that risk factor and understanding what you're trading, why you're trading, is very, very important. A lot of people want the risk of large caps, like they want the least amount of risk, but they want the profit of small caps. That's not realistic. You need to be realistic on knowing what you're trading. Me personally, when I started trading, I used to trade a lot of small caps. Now I'm strictly trading a lot of large caps, and I do option trading. That's what I'm primarily trading, but I have shifted, my trading style has shifted many, many times over the past few years, from trading small cap stocks to trading large cap stocks to shifting myself over to scalping and day trading options now. But that has been a progress that I continuously made. But over that time period, I've just learned more and more things about these different type of stocks, and then knowing, hey, if I'm trading this stock, obviously I'm going to have a different approach. If I trade a stock that's $4, right, not a large company, chart doesn't look great, I'm not going to hold this overnight. There's no way I'm holding this stock overnight. I don't care if it looks promising for tomorrow. I'm not holding it. I'm not comfortable. A large cap, maybe I'd hold it overnight. Not saying go and buy a large cap and hold them overnight because all large caps quote unquote go up. That's not true. There's a lot of bad large cap companies too, but it's just looking at the bigger picture and understanding the difference of the two different types of stocks. There's shitty stocks, and there's obviously good companies and bad companies. Bad companies can be traded, good companies can be traded, but your approach has to be different. And that's what I'm trying to get at with this explanation right here. Your approach has to be different with dealing with the shitty companies and the good companies, right? You can swing trade some of them, you can't swing trade some of them. You can day trade some of them, you can't day trade some of them. So understanding that, guys, is very, very important. Now let's move forward. Now, if you guys take a look here, this is a large cap. This is Microsoft. You guys can see until September 11th, this stock obviously has, for the past year, has been going up. These are large caps, healthy companies. People are looking to swing trade, maybe buy, position trade, and hold for a few months, few weeks, and they make 20, 30, 40%. Little risk, little downside. You guys can see even when the stock pulls back $8, $9, 7%, 6% in a matter of a few weeks. So these are large caps. Now this is another large cap, Uber. Now if you look at Uber, you can see not the best company. They haven't been doing well. So the message here is understanding that just because they're a large cap company, just because they're worth 20 billion, 30 billion, 40 billion, does not mean that the stock is always going to go up. Look at this company. It went from 46 all the way to 30, right? 30%, 35%, 40%, whatever that is. It went down about 30, 40%. A huge move down. But if you look at the move down, it happened over a course of about a month, right? So it takes time for these large caps to even move down, and it takes time for them to move up. Now, the reason that's important to understand is because depending on your risk tolerance, depending on your trading style, you need to understand and pick what type of stocks you want to trade. Now, here's a small cap. We're looking at Sunworks. This stock from April 1st till about May 6, 2019 went from about $3 all the way to 14. Huge move up, right? Very massive move up. Now, understanding that is very important, because now what some people don't get is they might say, well, I wish I bought here and I wish I sold there. Guys, that's not the reality of these type of companies, right? Because we don't know when it's going to fall. So the idea of trading this is buy, sell, same day. Buy, sell, same day. Buy, sell, same day. Buy, sell, same day. Day trade them. Day trade them like crazy. Make as much money as you can. Why? Because if you look at it, look right here. Stock was at 14, went from 14 all the way to 8 in a matter of a week. Went from 14 all the way to 4, right? Which is about a 70%, 60% drop in like 2 weeks. That's huge. 70% drop is huge. Not good. That's why you want to avoid holding these type of stocks in the long run. And then if you look at this from a bigger perspective, was $14 in May, and right now in September, this stock is at $2.81. So it's kind of like the stock lost about 70%, 80% of its value over the past 4 months. And that's why understanding that about small caps is very important. Now, not every small cap is bad. This is also another small cap, TNDM. Stock was at $2 last year of 2018, went all the way to about 50, and right now the stock is currently trading at 62. Massive move. Now, these are some of the few companies, some of the few small cap companies that are exceptionally well. They're very well managed, very strong companies, strong catalysts, huge growth. Now, obviously, finding those companies out of the full pie are very, 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 very small. Most companies that are small companies like this are shitty companies, but there are a select few that are good, but that's where your job kicks in as a trader to find them. If you're swing trading, position trading, maybe look to take a certain position, make some money on the trade, or if that's not the situation, you just constantly keep day trading it, right? Understanding that, once again, is very, very important, guys. Now, as traders, you need to know what you're trading and when, right? If you're starting out, once again, I recommend you start out with stocks. When you're trading stocks, what type of stocks do you want to focus on? Do you want to focus on the large caps? Do you want to focus on the small caps, right? Obviously, there's more money trading small caps, right? There's a higher profit potential, but there's also more risk. There's less profit potential. A lot of large caps move 4%, 5%, 2%, 1% a day. Small caps at times would move 40%, 30%, 100%, 200%. But there's also less risk with majority of these stocks. Now, moving forward from there, let's say you start off with stocks and you're like, you know what, I'm comfortable, I want to trade options. That's when option trading kicks in. All right, I want to trade options. What strike do I want to pick for the stock? What expiration? You know, all these things play a huge role if you go towards the side of options and you want to trade options. But starting out, guys, I recommend you to start off with stocks. Do not jump into options until you become more efficient. Now, the price action concept of trading all of these are very similar. The catalyst concept, very similar. Remember, when you're trading options, the options are moved based off the underlying asset, whatever you're trading. So if you're trading stock ABC and stock ABC moves up, obviously your call contract will move up as well, but there's also a lot more factors that go into that. But you have to understand, when you're trading options, options are moving based off the underlying asset, which is picked from these categories. Now, which one should you pick, or how should you go about it moving forward? Just the last message, take it one step at a time, guys. It takes one step at a time to mastery. To become very good at something, to become great at something, you need to focus on one thing. What I mean by that is, do not start off trading tomorrow, trade stocks, and then try to master options. And then while you're trying to trade stocks, you're trading every single stock, you're trying every different strategy and messing yourself up and spreading yourself too thin. Focus on one thing, build yourself up, and take it from there one step at a time. That's going to allow you to master trading. And then once you master one component, you can then shift. And then once you get to a level of mastery, you can sometimes say, you know what, today I think Stock Shop has a phenomenal play, so I'm going to trade options for it. Or today I see that stock ABC, which is a small cap stock, looks like it's up 40% pre-market. I think it can run. I'll trade the stock for it. But that's when you get to a level of mastery, once you get to a very comfortable and confident stage, which takes time. So you need to focus on one trading style, one trading instrument starting out, and then take it from there.